I'm going to discuss about 1998 Russian financial crisis case study using monetary trinity theory. This theory suggests that the policymaker cannot simultaneously achieve three policy goals, which is monetary autonomy, fixed exchange rate, and free capital flow. The Soviet Union was established in 1922 and collapsed in 1991, and the Russian Federation formed. During the Soviet Union era, the economics was entirely state control or command economy, which is highly centralized system that imposed strict control over the political, and economic life for remainder of the 20th century. Hence, the state control about all things included monetary policy and their exchange rate, and they also forego the free capital flow. During the new Russia formations, the former president Boris Yeltsin implemented shock therapy reformations, which aimed to shift from the Soviet-era command economy system to capitalism. Yeltsin's major initial move was to lift the price control and rapid privatization of the uh, state-owned enterprise. However, the reformation is too extreme, which is from entirely command economy rapid change to entirely free market economy. It brings the opportunity to the speculators to increase the price of goods to maximize their profits, which leads to a hyperinflation, wealth concentrations, and inefficient uh, resource allocations. In response, Rustin pegged the rubles to US dollar to control the inflations. Rustin also allowed the foreign investor to purchase the short-term treasury bills, which is GKOs in primary markets, and allow them to repatriate the income from this investment. This attract significant foreign capital, leading to a sharp increase in the Russian stock market. In the meantime, the first Russian-Chechen War, which took place from the 1994 to 1996, cost as estimated around 5.5 billion US dollar economic losses. The war leads to a large physical deficit and increased reliance on the short-term borrowing. And the Russia issue more short-term high-interest treasury bills, which is GKO. During the pre-crisis period, the Western government maintained a fixed exchange rate system by pegging the ruble to the US dollar. Concurrently, Russia implemented the free capital floor, which is permitting the foreign investor to buy GKO and repatriate their profits. This approach attracts foreign investment but sacrificing the monetary autonomy. Russia have Russia heavily relied on the oil and gas export and was hit hard by the 1997 Asian financial crisis. The crisis caused a sharp decline in the oil and gas price. The collapse of the oil prices significantly reduced the country's export revenue and causing the deficit to increase. To settle their obligation, a central bank of Russia has no choice. They have to print money, and the inflation increase and the ruble devalue. Central Bank of Russia spent nearly 6 billion US dollar of the foreign exchange reserve to defend the ruble. In the meantime, the non-resident holder of GKO entered into the forward contract with the Central Bank of Russia to exchange the ruble for the foreign currency, which means that it's allowing them to hedge against the exchange rate risk, which continue to increase the debt obligation to the Russia. The debt overload, oil and gas price drop, foreign reserve depleting, and the capital flight have significantly caused the 1998 Russia financial crisis. In response, the Central Bank of Russia announced and unpegged the exchange rate and devalued the rubles. A default on the domestic debt and a 90-day suspension on the payments by commercial banks to the foreign creditor. Hence, during the crisis, they abandoned the fixed exchange rate and regained some degree of monetary autonomy, which is enabling the central bank to manage inflation by using the interest rate. They continue have the free capital flow, but with some limit, like they posted the policy of 90 days suspension of the payment by the commercial banks to the foreign creditor, which is similar to the post 1998 crisis. The Russia continue abandon the fixed exchange rate and regains significant monetary autonomy, which is allowing the central bank to control inflation and stabilize the economy through the interest rate or the other monetary tools. Russia was also managed more cautiously while capital flow remained relatively open to reduce the speculations and the capital flood. It's recommended Russia to work toward to reducing its reliance on the oil and gas exports, as the oil and gas earning accounted for 45% of the Russian Federation budget in 2021, which is a major source of income for the country. Greater economic diversification would reduce the impact of the external shock on the exchange rate and capital flow. Thank you.